Year. So much to cover. We have a lot of movers for you. Diane King Hall, host of Morning Movers, is here with me now. And we've seen these financials doing so incredibly well. You have a few to feature.
They have been doing well. Today they're facing some headwinds, and I'm like, oh my goodness, of course I'm starting out with the laggards right now, but we'll finish on a winner here. So Bank of America and JPMorgan Chase under a little bit of pressure today, but they have been outperformers year to date. This is off the back of a ding from Baird. Baird downgrading its view on both of those banks. For JPMorgan Chase, they're downgrading it to underperform. They're keeping their price target on it, though. They have a price target of $235 a share. They previously were on the sidelines, neutral on JPMorgan Chase. They just think shares have gone too far too fast. They've surged over 40% from the April lows. But again, if you look at year-to-date performance for JPMorgan Chase, it's up just shy of 20%. So it is outperforming the S&P 500. But it feels like they've, give some caveats here. They still see JPMorgan Chase as the gold standard. They consider it best in class, but they do think it's already priced to perfection. It's got that fortress balance sheet. Everyone talks about that. It's got the dominance in market share, but they just see expectations as too high for JPMorgan Chase, and they think that there's just a value disconnect. For Bank of America, they've gone to the sidelines on this one. They're neutral. Kept the price target, though, on this one, keeping it at $52 a share. So that still signals a little upside from here. Bank of America also outperforming the S&P 500 year to date, not near the same level that we see with JPMorgan Chase. But again, it's been a strong performer this year. There was the expectation from many analysts at the beginning of this year that financials would be outperformers. They do think that there are positive trends still intact, but they think the stock just reflects that now.
So many of the guests say one of the catalysts to get to new highs will be mergers and acquisitions, more IPOs. I mean, that's all about the banks.
Yes.
The banks have been in such a strong position, and I know we have a bit of a pullback today, as you've noted with the Baird call, but an incredible run and maybe a great next 12 months. I mean, you still have an administration that has been regarded as business friendly and better for mergers and things. So maybe the idea of it all stalled a bit, but then could take off.
Yeah, and we could certainly see Baird have a change of tune, especially if we see some unlocking of more M&A activity, more IPO activity, which we started to see again because, a lot of that had stalled out this year due to, just the lack of clarity around trade policy. But we are starting to get more clarity on that front. So that kind of opens up the window for more of that kind of activity, more deal flow, more IPO activity as well. Yeah. So we could certainly see Baird change their tune, but for today, sidelines for Bank of America and then underperform for JPMorgan Chase. Nicole.
All right. And look, don't cry in your soup, folks. I mean, I'm just looking at Goldman Sachs 1 year up 50%, right around its new highs. JPMorgan 1 year up 45%, also around its new highs. So a little pullback today shouldn't make too much of a difference for you folks. How about Tesla? We look at the robotaxi launch that we saw on the 22nd, and that's been a big one. Canaccord with a downgrade has downgraded Uber and Lyft. So we're looking at that as well when it comes to the autonomous vehicle uncertainty.
Yes, they see this, this Tesla robotaxi as more of a headwind for these because, Uber has kind of pulled back on its presence when it comes to autonomous vehicles. And keep in mind, Uber hit a record yesterday. We're talking about records in the broader market, and we've seen various stocks experience those same kind of milestones. Uber hit its own new all-time high yesterday, pulling back amid this caution around Canaccord Genuity's view on it. The firm downgrading Uber to a hold. It's cut its price target to $80 from $94. They are just citing uncertainty around the rollout of autonomous vehicles as behind the downgrade. They're warning that you could see a shift if autonomy accelerates, and that could be a risk to how Uber operates. They do say, look, Uber is still strong operationally, and they continue to expand rideshare. They're the dominant player, obviously, in the space. But for now, they're moving to the sidelines. They're also moving to the sidelines on Lyft. They've slashed their price target significantly for Lyft to 14 from $22 a share. The rating again cut to a hold. They see just two paths forward for Lyft. They think, look, again, the autonomous vehicle could pose a threat, and that's their bear case, and that would leave Lyft on the sidelines in their view. Now they do present a bull case. Lyft adds some value in the, this hybrid autonomous vehicle model, and then they just have more kind of tactical flexibility, and they think it's just unclear how all of this will play out. So right now, shares of Lyft are under pressure as well. But to be fair, look, it's been an outperformer year to date as well, Nicole.
All right, next up, we're taking a look here at Estee Lauder and an upgrade there. And we're always so busy talking about Ulta Beauty and e.l.f. and people forget what a powerhouse Estee Lauder is with a global footprint and a lot of key names under the umbrella. What's the latest here?
I feel like this brings back the term the lipstick indicator, right? When you think about Estee Lauder and all the brands in its house, it owns MAC, it's its namesake brand, MAC, Bobbi Brown, etc. So look, HSBC upgrading its view to a buy rating on Estee Lauder. The new price target is $99. That's up from their $80, so that implies more than 20% upside from the levels that we saw by the close of yesterday. It's had several years of weakness in its share price. The past few years, or even if you go out 5 years, it's had some serious weakness because it's just faced, as you mentioned, Nicole, just a difficult competitive landscape because you have all these new entrants and cheaper price points that put pressure on Estee Lauder. But from here out, HSBC expects to see earnings rebound. They expect to see EPS double or almost double this year into the next couple of years. They also see margins expanding, so they see them being able to hold up pricing power. They see it expanding to double digits by fiscal year 2027. They think that's both due to, though, restructuring and cost cutting and not necessarily top line growth. Now, they do expect sales to still be under pressure. They're cutting their sales forecast to $14.4 billion for the fiscal year. That would be down single digits year over year, Nicole.
And look, people, no matter what, they seem to always go like the lipstick indicators you're saying. People, when they go out, they're going back to work. They're back to work more days. It's not a huge expense, but more and more people buy makeup and stuff, and skincare has become elevated from a discretionary to much more of a staple or a necessity, at least in people's minds.
Absolutely.
I would say.
I think so, and I think you started seeing that shift during the pandemic. So it's part of the, construction that you have to look at within beauty, right? And so Estee Lauder, to your point, with more people going back to work, back in office, they're going to buy the lipstick, they're going to buy the foundation or the blush just to present a certain way. And so that bodes well for Estee Lauder. And then the other thing is, look, they have been working on their turnaround story for some time, and you're seeing that play out even before today's advance. The stock had been higher year to date, so it's gaining more ground today.
All right, good to see you, Diane King Hall. Good luck there. Had a lot of names on the move this morning. Good thing we have all day to talk about them because we have a lot going on.